For the final session of today's conference, we have the pleasure of hosting Diego Parrilla, who's managing partner at a 1.8 billion euro Quadriga asset manager. And he's also the chief investment officer for Quadriga, EMEA, UCITS, which is a liquid anti-bubble strategy focusing on global macro, volatility, and tail risk. Diego is also well published and has co-authored with Daniel Lacal the bestseller, The Energy World is Fiat, Opportunities from the End of Peak Oil. He's also a sole author of Anti-Bubbles, Opportunities Heading into Lehman Squared, and Gold's Perfect Storm. Diego's topic today is bubbles versus anti-bubbles, the end game. We are delighted to have you with us. Diego, it's over to you. The floor is yours.
Thank you, Karam. An absolute pleasure to be with all of you. Hopefully next one we'll do it live in person. I'd like to start with a key concept that is not well enough understood, which is the idea of false diversification. And effectively, very often people have portfolios with a lot of things, but they're not necessarily diversified. And we see in this graph how events or crises effectively result in big moves, big collapse, simultaneous collapse of a lot of asset classes. And what you see in blue is the anti-bubble strategy that I manage, which is not something that happens just by skill, it happens by mandate. So the idea, is to be truly diversified, and we're going to address a lot of issues such as volatility and correlation and how the rules of the game have changed with the macro situation. I love the analogy of portfolios being teams. You can recognize a football team, a soccer field, and the idea is you have to play, of course, offense. You want to score goals, you want to make money, but it's super important also to play defense. I think there are two dimensions when you build your team that I'm going to go over and over today. One is the idea of risk on, risk off, and the other one is inflation. And when you think about your strikers, those assets that are more risk on, whether it's equities or credit, more midfielders like real assets or cash or anti-bubbles or government bonds, we have to introduce also this idea of inflation. And I think one of the key messages I want to leave today is how, there are certain things you must avoid over the medium long term, and that is assets that are short inflation, such as cash, credit, and fixed income. So in that sense, I think the team must be balanced at all times. You must have strikers, defenders, but we have to do that mindful of inflation and risk on, risk off. I'd like to also share, as Ram said, I coined the concept of anti-bubble, and I'd like to start by defining it and perhaps start with the idea of bubbles. Bubbles being, and I borrow George Soros here, assets that are artificially expensive based on a belief that happens to be false, a misconception. What I did is I generalized the framework and said, look, misconceptions can distort reality, but not only through artificially high or expensive valuations, you could also have artificially low valuations. So in that sense, the concept of anti-bubble is like they're distorted mirror images of each other. We're looking at artificially cheap assets. The second important dimension of the concept is that effectively, because they're distorted mirror images of each other, they're effectively two reflections of the same process. By construction, once the misconception is understood, you will have this move where the bubbles implode and the anti-bubbles go higher. And in that sense, an anti-bubble is like an antivirus or an anti-missile, is a defense mechanism against the bubble. And there's a third dimension which has to do with the contrarian nature of being against the consensus, and particularly looking with extremes of complacency or panic. One of the relationships, bubble, anti-bubble, that I like, just to show the example, is the relationship between equity prices and volatility. Here in the screen, we see the S&P and the VIX, and we see how periods of artificially low volatility, driven both qualitatively and quantitatively, such as complacency, or quantitative dynamics, such as trend following, risk parity, or vol targeting, effectively can lead to high valuations. But when things reverse, and either this is a reflexive process, so bubbles implode or volatility goes up, or vice versa, you get to see these dynamics playing out. And what we see is that, ironically, insurance in the financial markets tends to be cheapest when we need it the most. So when equity markets are super high, everybody's complacent, insurance is cheap, that's the time to accumulate. And arguably, when things go in collapse, in panic, it's the time to monetize. So just to complete the discussion, I'm an engineer, master's in mineral economics from the Colorado School of Mines and the French Institute of Petroleum. I'm a former, actually, JP Morgan. That was my first employer in London. I was with Goldman and Merrill with senior global leadership roles in commodities. And I've been also on the buy side as a portfolio manager with Bluecrest, with Diamond, Asia, and Old Mutual before I moved back to Spain. And as Khurram said, I've written 2 books. The first one, a bestseller on the energy space with a very contrarian thesis, and the second one, the anti-bubble, where I've had the honor also to do a number of contributions to very selective media, such as front page article in the FT, amongst many others. I want to summarize some of the key theses and the contrarian framework. And I'll start by saying that monetary and fiscal policies without limits, unfortunately, do not solve problems. All we're doing here is 4 things. The first thing we're doing is we're kicking down the can, down the road. We are effectively delaying those problems. We're not solving them. We are, through basically spending and borrowing, we are transferring in generational, etc. It creates a conflict. The second thing we're doing is we're transferring the problems. Trade wars, currency wars are very much the name of the game when it comes down to printing money. They're not just domestic measures. And we see, for example, in my opinion, how the European crisis of 2012 was in some way a response to the monetary attack and abuse from the US, and how by being pegged to the yuan and with the massive appreciation of the euro, that created certain problems. So currency trade wars are very much a part of this abuse. And what we're doing also is we're transforming the problems. We're seeing trillions of money being printed, inflation, which is key for today's discussion, and also inequality, which leads to social unrest and, unfortunately, geopolitical events. We, as students of history, we must see that what's happening today, it's happened, unfortunately, in the past. And what it does altogether is we're really enlarging the problem. So what we're seeing today, in my opinion, is a massive distortion of valuations with artificially low interest rates, with etc., which are leading to bubbles that are by now too big to fail, and central banks that are trapped between inflation and bubbles. And I think invariably they will favor inflation, and effectively we're heading into the unfortunate situation of stagflation. Which let's go into a bit deeper. I summarize all of this in 2 sentences. I'd say the last decade for me is the transformation of risk-free interest into interest-free risk. Once upon a time, we had the bond or treasuries paying 5% with low inflation, so nice and healthy real yields. We've seen the transformation with monetary and fiscal policies without limits to effectively a world where you're taking a lot of risk without any compensation. In fact, negative nominal and real yields. And what I think this is going to lead us is this bubbles, transformation of bubbles too big to fail into stagflation. Going in more detail at what's driving this, first is this idea that you can actually print your way out of trouble. And this takes obviously many forms. We talked about currency and trade wars, the introduction of zero nominal rates, quantitative easing, QE, and yield curve control, which we've seen in Japan, and I think will come along in other countries and regions. What it means is we're no longer just printing 120 billion a month. They're going to print infinite amounts so that yields are well behaved. 0.1% in the 10-year. Japan, for example, I think this is something we might see in Europe and the US down the line. And this leads also to the idea of deeply negative rates and going beyond just printing money to buy government debt, to buying corporate and other issues. And lastly, last year, including MMT, this fallacy that you can actually print money and spend ad infinitum and increase debt ad infinitum without the need to raise taxes or creating inflation, which is a fallacy. So I think, as Voltaire said, ultimately paper money, if you abuse monetary policy, will converge to its intrinsic value, which is paper. The second dimension is this idea that you can borrow your way out of a problem, which is also a fallacy. And we've seen government spending, debt, obviously dynamics on fiscally on taxes, bailouts, unemployment, and all sorts of conflicts during the recent crisis, and MMT, etc. And famously, I think Larry Summers wrote this article called "The Prudent Imprudence," of effectively fiscal expansion. And this is somewhat crazy, but yeah, we see governments taking infinite, almost if you let them, debt at zero or negative interest rates. Who wouldn't? The only problem is you can't really normalize monetary policy. If you were to increase interest rates, the entire system, my country in Spain, of course, would be bankrupt. So it all looks very easy on the way down. At zero interest rates, we take a lot of debt. You just can't unwind it. So we go into this idea of, you can inflate your way out of a problem, which is part of the situation. And I use the analogy of inflation being like the frog in boiling water. And what it means is, if we are like frogs in this monetary broth. If you put us in low, mild inflation, and you increase temperature inflation by 2 degrees, 2%, whatever, per year, we might stay in there and get diluted and eventually die, boiled. If you actually throw a frog into high inflation or high temperature, it will jump. And so in this sense, what's important to understand is this 2% is not just a random number. I think it's been scientifically calculated so that it's fast enough that it will dilute us at a fast pace, but slow enough that we frogs will stay in the water. And so this problem becomes bigger because official inflation is not, in my opinion, reflective of reality. In fact, my rule of thumb is that real inflation is at least twice official inflation. So the exponential impact of inflation on the dilution of purchase power is way greater than they make us believe. There's obviously a lack of central bank independence. Just look around at the political appointments. And in this entire debate of inflation versus deflation, it's clear that there are many deflationary forces in the system, whether it's technology, demographics, overcapacity, amongst others. But all they are, it's really a cushion they give for central banks to print even more without creating this impression of inflation. So they're neutralizing the positive, let's say, deflationary forces that you might get through technology by printing even more. But the emperor has no clothes, and ultimately, I think we're going to look into inflation expectations more. I think central banks are trapped, and we're a new paradigm where I have a very negative view against the consensus, which is we will see both inflation and low interest rates. As of today, the market is trying to price interest rates higher. I don't think that's possible, because if you hike interest rates, you destroy the bubbles, which are systemic, and that is the dilemma and the trap. So looking at bubbles too big to fail, first thing is that you remember from the textbook, some of us that are old enough to remember, there was this idea called risk-free interest. That doesn't really exist anymore. There's nowhere where you can park your money and be protected and be effectively earning positive real yields. It's been gone for a long time, pretty much across the entire world. In fact, we're very deeply into negative rates. one of the consequences is that the 60-40 balance portfolio model doesn't work anymore. Your defender, which was fixed income, your 10-year bond that paid 5% nominal, meant that in a crisis, if interest rates went to zero, the bond would make you 50% capital gains and protect against the losses in the equities. In a world where the bond is already at zero or negative yields, the room for appreciation is minimal. And that's why I call the bond, Beckenbauer. This is like, it was a great defender 30 years ago, not anymore. And this all comes from this idea that, you have artificial low interest rates. And artificial low interest rates means artificial valuations, because most of the valuations in the system are based on discounted cash flows. So this little table shows how at 5% interest rates, $100 that you would receive in 50 years are equivalent to just less than 9 today. With zero interest rates, you don't need to be a genius to know that the PV is parity, is par. So effectively, anything that has long duration, such as the NASDAQ, has been a major beneficiary of this. But ultimately, we need to understand that artificial low interest rates create artificial valuations. It's all, in some ways, part of this wealth effect that we build. And so we're now in a situation where these bubbles are too big to fail. They create systemic risk. What would happen if things were to normalize? And the idea is, I'm sorry, you cannot normalize. We saw a little bit of a scare in Q4 2018 when famously Jerome Powell was going in autopilot and put rates 2.5, and the expectations is it would continue, and they had to go quickly into reverse to sort of avoid the crisis that was unfolding. And we brought down to 1.5%, and that was pre-COVID. Since then, the level of debt is much higher. The system is way more fragile. So in my opinion, the hikes that are priced into the market will not realize. I think we're trapped. So looking into some bubbles, specifically, I've done a lot of work, and you'll see into a number of areas, but one of them, and this has been a very contrarian view until recently, but I do believe that China is one, arguably, of the biggest bubbles ever. And I think if you look into the details of the double-edged sword of central bank planning, the number of wars that China has opened, trade wars, currency wars, political, technology, and cultural with the West, and the bubbles have been created in housing, credit, infrastructure, where I actually see Evergrande a bit like a Bernstein's moment. We'll look back and connect the dots. And the problem is being so large, yes, there's going to be a contagion effect that will be global. It will impact consumption growth. And I think ultimately the degree of freedom of the system is a large devaluation of the yuan, which is a very contrarian trade relative to consensus. The catalysts, definitely energy could be one, also volatility. So I think the general idea is that every time China is in trouble, they know what to do, but unfortunately they will always revert to the same things, which is print, lend, spend and subsidize. So you need to guarantee people, bail them out. And this dynamic, I think it's something that ultimately will show through the currency. Another area that I've been highlighting for a long time is that, this idea that inflation is temporary. And I think the energy market shows that it's much more structural, and risks have been, this is a slide, by the way, I've been using for several months. It's nothing new. And it was already a problem prior to the Russia-Ukraine war. It's a global problem in energy. We have, it's affecting many sectors. We've been lucky so far that the winter is almost out of the way. Had we had a very cold winter, would have been even worse. We've had obviously this cycle with focus on ESG and hydrocarbon fuels are the enemy, and that's created a severe lack of investment, which will not be solved quickly. We've seen the response from post-COVID, obviously, with a very strong recovery. And bad news is energy prices are very inelastic. So if you want to destroy just 1% of demand in crude oil, you need 20% higher prices. So this is why we see these exponential movements. And obviously, geopolitics becoming a big problem. And I have bad news is, for central banks, which is you cannot print oil. They will try to print dollars to subsidize the energy, but this actually feeds back into the problem. So I think the key thing is now, as inflation expectations accelerate, can central banks lose control? And I would say there's a misconception in general that is, okay, long-term yields actually reflect, the path of short-term yields, and they go up because central banks hike. I would almost argue the opposite. I would say, well, in reality, long-term yields go up because central banks don't hike. And what's happening is this, as frogs, as we see inflation going up, eventually want to jump. And as you jump out of cash, fixed income, or credit, that means yields go up. And obviously, big problems for those on the other side. If you hold that cash, within, I think, $100 or euros in 30 years will buy you absolutely nothing. You're going to lose the purchase power almost entirely. And as inflations accelerate, people will be effectively jumping out as frogs. And I think central banks will be forced to intervene. And that's why I talked about yield curve control as a real possibility down the line. So I think it's important to understand and why central banks have to do something about this and pretend they're doing something about it. With low inflation, I think they're in complete control. They can do whatever they want. In a high inflation scenario, it's a very different picture. So, I have teenager boys and a girl, and if I had to explain the investment game, if it was, let's say, a video game, I would say that the investment game has 3 levels. The first level would be, can you make money in nominal terms? And we've been playing this game for a while. We've been playing, can you make $100 more than $100, right? But the reality is you can do that relatively easy. Just take your money and put it in credit and buy whatever Telefonica bonds for 20 or 30 years, and your 100 euros will be 101. Okay, you look good theoretically in nominal terms. Bad news is we are now deeply into level 2, which is, guys, inflation's high, and unfortunately, you're losing a lot of purchase power. So especially with real inflation. And I think benchmarks have a lot to blame. I mean, I had a meeting the other day with a huge Spanish account with, over 100 billion in just fixed income. And I was looking at them saying, you're an insurance company, you have, very long duration, and, all these savings are basically going to vanish in purchase power. So, and they were arguing, well, we're benchmarked and there's not much we can do. So I use the analogy of benchmarks being a bit like cyanide pills. So my benchmark might say I need to take 2 cyanide pills a day, and I only take 1, therefore I'm underweight. Well, bad news is not good for your health. And level 3, just to complete the picture, is of course taxes. So this is a complicated game. You have to make money, obviously, in nominal terms. You need to beat inflation, and central banks and governments will square the circle with taxes because they inflate. Basically, they create inflation, which hurt the poor, and they create inflation that benefit the rich, but you're going to tax the rich anyway. So this is almost is a very, very difficult game. To go from inflation to volatility, I use the analogy as an engineer of fluid mechanics and laminar versus turbulent. And I would argue that the markets go from predictable, linear to chaotic once the VIX breaks. I'd say 40 as a line in the sand, but the reality is once you break certain levels of volatility, fundamentals don't matter. Don't matter because, volatility, I talk about volatility as the speedometer of the markets. When implied volatility and realized volatility are low, this is like you're driving your car, let's say at 300 kilometers per hour, but the speedometer says 90. If you have an accident, boom, what do you feel? Well, of course, you're going to feel the real speed you were running, whatever the speedometer said. And this is what happens with volatility. You might believe that the risk is low, ex ante, but the real risk you're running is the risk you're running, and you get these surprises. The problem is that as volatility goes up, effectively you start to see forced delevering. You have value at risk going up, you have margin calls, you have stop losses, and what happens is liquidity starts to be an issue. Triple whammy of volume, price, and time, which actually feeds into consensus positioning and polarizes correlations to +1 or -1. And the combined effect, the compounded effect of volatility going up, liquidity drying out, and correlations polarizing means that risk grows exponentially, which feeds back into forced liquidation and volatility. And this is the reason why central banks have been so obsessed preventing these big moves in volatility, because they know that the snowball, once it gets out of control, is very difficult to contain. So we see here scenarios and this close relationship between prices and vol, the flip side being the melt up with artificially low vol and the new renewed movement. So if you think about this, how do I build my team? You know, and volatility, I've talked a lot about it. Sounds like the VIX would be a great piece to own. Bad news is the VIX, you know, this is the timeline is taken since we launched our strategy. You see how the VIX, the spot index has gone up over 200, you know, since inception, but the actual investable ETF or rolling futures would have lost over 80% of the value. So incredible divergence. This is something that happens because of for those who are familiar with commodities and contango backwardation, you need to roll these positions. And unfortunately, the VIX and the risk premium means that you've had over 10% negative carry per month. So just being early or wrong for a few months in futures could mean that you blow up and you lose your capital, which makes it very difficult to actually make money back. We're now in a period of backwardation, which should be a strong signal from a quantitative perspective, but things will remain volatile. Just to bring some quantitative elements, these are short-dated options expiring. It is options on the VIX, so effectively is vol of vol. We see high levels of elevated volatility and extremely high call skew, which is consistent with this asymmetric view of what could be ahead. Relatively easy and interesting strategies that take advantage of this skew might be to play call spreads or other things. But ultimately, very tricky to be a defender given the carry. So just to familiarize people with what we do, we run a strategy that has been best performing strategy in the world during the COVID crisis in Feb and March. It has also is up over 35% year to date. And this is something that we do through anti-bubbles, which can include things like gold, duration, but most importantly, insurance. And the one thing that makes us very unique is we only buy options. And effectively, we buy put options on risk assets, on bubbles, and call options on anti-bubbles. With that explains, you know, and for those interested in learning more about this, happy to have follow-up discussions. But this is something that by construction gives us this goalkeeper behavior. If you actually look at the team, and I just looked at a very simple team, 50-50 striker goalkeeper, you see that the actual team being balanced is much more stable. So this is very, very important to understand the power of real diversification when you build a team. You cannot have a team just with 11 strikers or a team with 11 goalkeepers. But I think it's also very important to understand that when you build these teams, these portfolios, the power of rebalancing. And this idea is, you know, some people think that investing is about having a crystal ball. Oh, you guys are so smart, you know what's going to happen. Honestly, nobody knows what's going to happen. And if they tell you differently, they're lying. Nobody really knows. Anything could happen. In fact, for me, managing money is the opposite of having a crystal ball. Is I'm going to, whatever happens, you know, I'm going to have strikers, I'm going to have midfielders, I'm going to have goalkeepers. You're going to play the match. You're going to enjoy the volatility. You're going to play around. And what you see here is how just a very simple monthly rebalancing would have added a significant return whilst you're sleeping. You don't even need to worry about it. You say, well, fine, the goalkeepers are expensive. I'll take some profits and buy strikers and vice versa. So this is about building the right team and playing for the long term. And going back to my earlier point, I think the next decade is going to be very different from the previous one. It's very important that when you build your portfolio, you're truly diversified. And you have to have both strikers, midfielders, and goalkeepers at all times. And I think you must do it, in my opinion, having inflation as a key variable, because I think is one of the risks on the exit plan. So with that, I'll conclude. And I thank you, everybody, for your interest. And Ram, I don't know if there are any questions from the audience. Perhaps we could take a look.
Thank you very much, Diego, for an interesting presentation. There's a few questions that we have from our audience. The first one I've just selected is that if you can just elaborate on the role of volatility. You use that alongside inflation, but volatility generally works on the way up as well as down. Can you just highlight from your work, what is the best way to use volatility in that asset allocation process?
Well, as you said, I think volatility plays both sides. I mean, you could actually have strategies that are in some way short volatility, that they get some carry, but you also need to balance that out with other sides. I think the important thing is to embrace volatility. You can't fight volatility. And that means that within your team, you must have parts that are asymmetrically long volatility that they benefit, but we obviously must look into carry and other considerations. And secondly, as a team, you also must embrace volatility through rebalancing. And when you do that, I think the compounded returns in the long term will actually be very additive, instead of trying to pretend that you have a crystal ball and that you can time everything perfectly. This is more about build the right team, delegate to the right players, and enjoy the ride.
Thank you. And just to put one more question to you, from your presentation, you described that central banks will find it with great difficulty to raise interest rates. Maybe the market needs to reprice where the Fed's interest rate cycle is heading. What is, in this backdrop, the most, what is your asset class of choice with this backdrop of maybe rates not rising as much as the market believes?
Well, there are a number of implications, of course. I think the market is, can swing. My personal view is we will, I don't think we'll get to 1% in dollar rates. They have to hike, they will hike, but things will happen. They're already happening. So in that scenario, there are many things that are already pricing in, somewhat normalization. I think there are things you need to avoid, and then things that might do well. Honestly, I think the portfolio that we run at Quadriga is strongly positioned. I believe in gold. I believe in duration, but over everything, I believe in insurance. And that includes, dollar plays, includes correlation plays, geopolitical hedges. And I think there are significant opportunities, some of which are perhaps a bit more technical in the implementation. And that's why perhaps they must be delegated to people or outsourced to people that are specialists in this. So I think ultimately, as I said, the portfolio is a team, and you're the coach. So you decide how you want to play it and which players you want on the field and how you want to change them. But there are many opportunities that I think will be best captured if you can actually count with some of the specialists on your side.
With that, thank you, Diego, for being at our conference today, for your insights and valuable experience. We appreciate you being at our conference. Thank you very much for your time.
It's been my absolute pleasure. I hope you found it helpful, and much health to everybody. Thank you.
Thank you.